Hello, everyone. Welcome to Chapter 4. So, we've talked about items that need to be included in income. In this chapter, we're going to start by calculating our gross tax payable, and then we're going to be able to reduce that payable by providing us with tax credits. So, we're going to calculate how those affect taxes as well. Um, this chapter has a long list of various tax credits we will be discussing. So, for that reason, it's one of the reasons why this course is an open book course because each credit has its own amount. Certain credits have income thresholds that as you earn more income, the credit itself is reduced. So, I wanted to remind everyone that if you go to the content section in Module 4, there's a document here, tax rates and credit sheets. There's also, if you go to course information, there's another copy up there as well. So tax rates and credits sheet, and this page comes from the textbook, and it's basically a summary of all the credits that are available. And we will be covering a good number of them, not all of them, but this is a great reference sheet. If you, let's say, for example, we see the age credit. So the age credit base is $9,028, but this credit starts to degrade once a person's net income exceeds 45,000, and it's no longer available once that income reaches $105,000. So that's the age credit, and caregiver credit 8601. Adoption expenses can be 15% up to 19,580. So each credit has these collection of numbers that are associated with it. And I don't expect you to know these numbers off the top of your head. So please have access to this summary sheet. We'll be able to run through it, or when you're taking the quiz and we discuss, oh, what's the caregiver credit amount? It's a quick reference for you to go to it instead of rifling through the slides or something. So it's a good reference sheet. I will be going through the PowerPoints and I'll be doing the exercise as normal, but this is a great reference for you guys to use in your initial reading of the chapter and in reviewing it for studying purposes. So, taxable income and taxes payable. So when we are discussing net income includes our various employment income inclusions, our perks and benefits, business and property, net capital gains, other sources, other deductions. This calculates our net income. From Division C deductions, that brings us to taxable income. So that's our first step, and that's kind of what we were doing in chapters 1 to 3. In this chapter, we're going to be going to the next steps. We have our taxable income. From it, we calculate our gross federal taxes, and then we can subtract from it certain income tax credits. Available taxable income deductions. We mentioned employee stock options in Chapter 3. So stock options are entirely included in income, but a deduction allows us to subtract 50% if we have the right situation. We're not in the money. But there's other types of deductions. Deductions for payments we'll mention. There are capital gains deductions, and it's from these sections that losses become deductible. I don't expect you guys to know all of these various deductions, but to highlight one, for example, we have deductions for payments. So deductions for payments is we've received a type of income. It needs to be included in our net income for reporting purposes, but we might not have to pay taxes on it, so it will be deducted to protect it from taxes. So if we have certain income amounts that are the result of an income tax treaty, and then that we are exempt from, so we have to report that we are receiving the income, but we then get to deduct that exempt amount out. So reporting to Canada saying, yes, I'm earning this income, but it's from another country, it's exempt, so I will remove it, and only what's left will be taxable. If I'm receiving workers' compensation payments from WSIB or some other sort of employment insurance, I will report the income in my return, but I'll likely get to deduct those payments from my taxable income, so I won't pay taxes on it. So deduction of payments is listing out these situations where I still need to report the income, but I get to subtract it before we get to that taxable income stage. So we have our taxable income. What do we do with it? Canada tax is a progressive system. The more the more income you earn, the higher your marginal rate of taxes is. So if my income is between 0 and 57,000, My federal tax rate is 15%. Now that 15% is for all of the income up to that 57,000. Only the income that's after it goes to the next rate. So these is why we call them marginal rates. So if my income is 57,375, the next dollar I earn will be taxed at 20.5%. So I'm opening up the calendar just to show you something. So 57,375 times 0.15, that 15% comes to 8,606.25. You see here, 8,606. So because that 15% is applied to what we call these different levels brackets, so that 15% applies to the whole first bracket. So if I earn exactly 57,375, we know that that tax rate's going to total 8,606. That's the full income at 15%. So when we're actually calculating taxes payable, the bracket that we're in, we only are calculating taxes on the amount of income in that bracket. So if I made $60,000, only about 3,000 of it is in the bracket. So I start with a federal tax of 8,606, which is that amount at 15%, and then I apply 20.5% to only the $3,000 I am over this amount. I'm trying to emphasize this because a lot of people have the idea that once you make $57,000, now all of your income's taxed at 20.5, but it's not. These are marginal tax rates. These are rates that only apply on the next dollar. So once my income gets close to 115,000, the amount of tax I would have accumulated in brackets 1 and 2 is 20,368. So the next dollar I make will be taxed at 26%. So everyone in Canada, everyone who reports income to the Canadian government to be taxed, we all pay 15% on that first 57,000. We only pay 20.5% on the next 57,000. So yeah, so don't worry if you make a bit of money, you haven't suddenly lost out. You haven't lost the income you had before. It's only on your additional dollars that these tax rates apply. So use of marginal rate means that for the first 57,375, taxable income rate is 15%. If an individual's taxable income exceeds that 57,000, their federal tax will be 8,606. If an individual's income was exactly 114,750, the first 57,375 is taxed at 15%. The next 57,375, which is the difference between those tax brackets, is taxed at 20.5%. So that means at if I made exactly 114,750, actually I'll do it like this. If taxes of 368 divided by my total income of 114,750, although my marginal rate is now 26%, on average over all of my income, I'm only being charged 17.75%. These tax rates average themselves out through the brackets as we move through them. So if an individual has taxable income of $300,000, that amount of income puts them into the final tax bracket. So the tax on the first 253,414 is 58,686, which there's our federal tax starting point of that bracket. And then they'll pay 33% on only the dollars over the tax bracket. So 46,586 will add 15,000 to it. So the total gross federal tax is $74,060. So our marginal tax rates at that top bracket is 33%. But when we actually say what's the average, my total taxes owed was 74, but I made $300,000. So take 74,000 owed divided by my entire income, my average tax rate was only 24.69%. So I've paid on average 24% despite my marginal rate being 33%. So that's why we always differ between what's called our marginal rate and our effective tax rate. Now, we're just talking about the federal Tax rates, provinces add on top of these their own tax rates. The minimum is 4% in Nunavut. The maximum tax brackets in Nunavut is 11.5, but Newfoundland is 21.8. The lowest tax bracket in Ontario is 5.05%. Their brackets also differ slightly, but for the purposes of this course, we'll keep those income levels sort of consistent between federal and provincial brackets, so you can just apply them evenly, I guess you'd say. So for provincial territorial res, other than business income, individual's income is subject to tax in province territory where you live on December 31st. So I live in Ontario. Ontario is my provincial tax rate. If next year I move to Alberta, as long as I move before December 31st, Alberta will be the new province that applies its tax rate. So just to do a little calculation to help drive this point home, because I love my math, I will just manually make it bigger then. Calculation of gross federal and provincial income tax. So in 2025, Emery Vo is a resident of Ontario and has calculated her taxable income to be $60,000. Assume Ontario's income tax rates are 5.05% on the first bracket, 9.15% on the next 57,000. What is the total federal and provincial income tax payable before consideration of tax credit? And we'll also be interested in what's the average rate. So this is easy enough. I've constructed these brackets. Now, if you actually look at the tax return, which maybe I will show you one in the next video, this is roughly how the federal tax calculation appears. We have our various brackets. We know that if I get to the top of this bracket, the taxes will add up to 8,606. So I only need to put my income in the next bracket. So we made 60,000. We will subtract from it the income accounted for in the first bracket. So we only need to calculate the excess amount, the 2,625 by which we are over. That applies the second bracket rate of 20.5%, which means we're adding to this bracket tax base of 8,606, another $538. So the total federal tax will be 9,144, but we're going to add provincial taxes to this. So they mentioned that 9.15 is the second tax bracket. Doing the calculation, the bracket base is 2,897, the excess 2,625 at the marginal rate of 915. We will be charged an additional $3,138 for provincial taxes. So these two amounts combined means we need to pay a little over $12,000 in taxes. That is what we owe. These amounts combined, 20.5 and 9.15, is a marginal tax rate of just short of 30%. It's 29.65. But our average tax rate, our effective tax that we're paying, we take our total tax, divide it by our income, and we are being charged 20% of our income for taxes. So even though the next dollar we earn will charge 29% for taxes, right now we've averaged just over 20% for taxes. So that's the difference between our marginal and effective. Now, if I've constructed this properly, if we want to play around with taxable income, you can see how it moves through the bracket. So let's make our income $200,000. It will now move over to the fourth bracket. This income's within this range. We are $22,000 into this bracket. So our total taxes is $43,000. So our marginal tax rate between the two columns or two tax bases is 41%, but our average tax rate is just over 30%. So that's how this thing works. So feel free to play around with the income, see what it's doing as it moves through the tax base. If I was to calculate this bracket at 15% plus this range at 20.5 plus this range at 26%, it would come out to 36,782. So we always know the base tax amount, so we only need to calculate that excess. Okay. I hope I've sufficiently driven that point home because that's pretty much the end. We're going to talk about actually calculating taxes. For the rest of this chapter, we're going to go at length of various credits. So thank you for your time. I will see you in the next video.